As you watch this video, the United States military is spending approximately $1 billion a day in active operations against Iran. $1 billion every 24 hours. That is more than what the entire country of Liberia produces in a full year, disappearing into a single day of military operations. The Center for Strategic and International Studies has estimated the first 100 hours of those operations alone cost $3.3 billion. And here's the number almost nobody is saying out loud. This did not start on February 28th, 2026, when the bombs fell. The financial cost of the US-Iran conflict is not measured in days or weeks. It is measured in decades. Economists, researchers, and historians who have tracked the full price tag of this relationship, including the covert operations, the sanctions regimes, the frozen assets, the proxy conflicts, and now the direct military engagement are looking at a number that dwarfs most modern wars. And the accounting goes back much further than you have probably been told. So here's the question that nobody in the headlines is asking right now. What does this conflict actually cost? Not just what it costs this week, with carrier groups burning through fuel in the Persian Gulf, and munitions being fired at a pace that the Pentagon itself admits was not budgeted for. The real question is what this conflict has cost over its full timeline, because the US-Iran confrontation is not a recent event. It is a 70-year financial relationship built on oil, covert action, sanctions, frozen assets, and now outright military strikes. And the total bill, when you add it all up from the very beginning, is one of the most staggering numbers in modern geopolitical history. To understand it, we need to go back to where this whole thing started, because the origin of this conflict is not the 1979 hostage crisis. As most people assume, it is 1908. And it begins, as most things in this part of the world do, with oil. In May of 1908, a British geologist working for a man named William Darcy struck oil in the Khuzestan province of southwestern Iran. It was one of the largest discoveries of the age. Within 2 years, the Anglo-Persian Oil Company had been established, which would later be renamed the Anglo-Iranian Oil Company and would eventually become BP. This company, majority owned by the British government, built what was at the time the world's largest refinery at Abadan. It exported Iranian oil across the planet, and the terms of the deal it operated under were, by any objective measure, deeply imbalanced. The Anglo-Iranian Oil Company was required to pay the Iranian government a royalty of 16% of its net profits from selling Iranian oil. 16%. And according to researchers who later examined the records, the company likely paid even less than that in practice, because no outside auditor was ever permitted to check the books. By the late 1940s, the British government was earning more in tax revenue from Anglo-Iranian Oil Company operations than Iran itself was receiving in royalties. That is not a controversial claim. It is a documented financial fact that came out when Iranian parliamentarians began demanding to see the accounts. The profits from Iran's own oil were enriching the British treasury more than the Iranian state. And in 1951, when a democratically elected Iranian prime minister named Mohammad Mossadegh pushed through a parliament vote to nationalize the oil industry and take it back into Iranian hands. What happened next set in motion a chain of financial consequences that has not yet finished playing out. Here's the first twist. The British response was immediate and economic. London organized an international boycott of Iranian oil so comprehensive that Iranian tankers were turned away from ports across Europe. International companies refused to handle Iranian crude. Financial restrictions cut Iran off from hard currency. Oil production collapsed. Thousands of workers lost their jobs. The Iranian government, dependent on oil revenue, faced a fiscal crisis. And then Britain went looking for help. The United States entered the picture in early 1953. The Eisenhower administration, concerned about Soviet influence filling the vacuum of a destabilized Iran, gave the CIA the green light for something called Operation Ajax. CIA Station Chief Kermit Roosevelt, grandson of President Theodore Roosevelt, entered Iran covertly. The agency began placing anti-Mossadegh propaganda in Iranian newspapers and funding street demonstrations. On August 19, 1953, Mossadegh was arrested. The Shah, who had briefly fled to Rome, returned to power. And the 70-year financial confrontation that we are still living inside today had its origin point. The financial architecture that followed the coup is worth examining closely, because it tells you everything about why this conflict has been so expensive for so long. After the coup, the Anglo-Iranian Oil Company did not simply get its monopoly back. American oil companies demanded and received a seat at the table. An international consortium was established in 1954 in which British Petroleum held 40% 5 American companies, including Standard Oil of New Jersey and Standard Oil of California, held a combined 40%, and Royal Dutch Shell and the Compagnie Française des Pétroles held the rest. Iran received improved revenue percentages on paper, but the pricing, the distribution, and the downstream infrastructure remained under external control. Nationalization survived in name, the financial structure endured. What the coup also did, and this is the part that most financial histories skip over, is guarantee the eventual explosion. The memory of 1953 of a CIA-backed operation that removed a democratically elected leader who had tried to reclaim his country's natural resources embedded itself into Iranian political consciousness so deeply that 26 years later, it was a direct factor in what happened next. In 1979, the Shah was overthrown. The Islamic Revolution brought Ayatollah Khomeini to power. American diplomats were taken hostage in the U.S. Embassy in Tehran, 52 of them held for 444 days. And the financial retaliation from Washington was immediate. President Jimmy Carter froze approximately $12 billion in Iranian assets held in American banks and overseas accounts. That single act set the financial template for everything that followed. Iran's money held in American-linked financial institutions could be seized, frozen, or denied at Washington's discretion. That was the core of the financial weapon that the United States would spend the next 45 years wielding. After the hostages were eventually released in January 1981, the assets were unfrozen as part of the Algiers Accords. But the sanctions did not end. They evolved. By 1987, U.S. sanctions were reimposed in response to Iran's actions in the Persian Gulf during the Iran-Iraq War, which had begun in 1980. By 1995, sanctions were expanded under President Clinton to cover essentially all U.S. economic interaction with Iran. And a 2012 report by the National Iranian-American Council found that between 1995 and 2012 alone, the United States sacrificed between $135 and $175 billion in potential export revenue to Iran because of those sanctions. That is a cost to the U.S. economy, not a cost to Iran. A cost to American exporters, American manufacturers, and American workers who lost sales they would otherwise have made. The report estimated that the lost export revenues translated into between 50,000 and 66,000 American job opportunities every single year. That number gets almost no coverage. The sanctions on Iran have never been discussed in terms of what they cost the country imposing them. The conversation is always about the damage done to Iran. But financial isolation is a two-way door. Every sanction is also a forfeited transaction. Now here is the secret at the center of the entire 70-year financial story. The Iran sanctions regime, which reached its peak intensity between 2012 and 2015, and again from 2018 onwards, was the most financially destructive peacetime economic operation the United States has ever conducted. And the numbers are extraordinary on both sides. Between 2012 and 2015, international sanctions cost Iran over $160 billion in lost oil revenue alone, according to U.S. Treasury Secretary Jacob Lew, who said in April 2015 that Iran's economy was between 15 and 20% smaller than it would have been had those sanctions not been in place. More than $100 billion in Iranian assets were held in restricted accounts outside the country, frozen inside financial systems that could not be accessed. The Iranian rial lost 56% of its value between January 2012 and January 2014. Inflation hit 40% annually at its peak. Unemployment reached an estimated 20%, and at its most constrained, Iran was exporting around 750,000 barrels of oil per day, compared with 2.5 million barrels per day before the sanctions escalated. The cumulative cost to Iran across the decades of the sanctions regime, when you account for all lost oil revenue, all frozen assets, all destroyed investment relationships, and all infrastructure that was never built because the capital was never available, runs to estimates between $300 and $450 billion in lost oil revenues alone, according to Iranian government figures. That is the bill for being on the wrong end of the world's most sophisticated financial weaponry. In 2015, the Obama administration negotiated the JCPOA, the Joint Comprehensive Plan of Action, the Iran nuclear deal. This was the moment when the financial architecture of the conflict briefly began to reverse. Iran agreed to dismantle 2/3 of its nuclear centrifuges, ship 25,000 pounds of enriched uranium out of the country, fill its heavy water reactor core with concrete, and accept unprecedented IAEA inspections. In exchange, the United Nations, the European Union, and the United States lifted the nuclear-related sanctions and unlocked access to frozen assets. The deal was hailed as the most complex multinational financial negotiation since World War II. The 159-page document and its 5 annexes were the longest multinational agreement text of any kind since 1945. But here is the part that was buried in the financial fine print. The amount of money Iran could actually access immediately was far smaller than the headline figures suggested. U.S. Treasury Secretary Jack Lew estimated that out of more than $100 billion in nominally frozen assets, Iran's central bank itself said only about $30 to $32 billion was genuinely accessible. The rest was trapped in Chinese project finance collateral accounts, illiquid currency holdings, or escrow arrangements in countries like South Korea, India, and Japan, where the money was denominated in local currency and could only be used to buy goods from those specific countries. The $100 billion figure was real. The freely usable portion was a fraction of it. Oil exports recovered quickly. By 2016, Iran was exporting over 2.1 million barrels per day, back near pre-sanctions levels. The economy grew by nearly 14% in the Iranian year 2016 to 2017 as trading relationships with European partners resumed. French, German, Italian, Chinese, and Russian companies rushed in to sign investment agreements. It looked briefly like the conflict might finally have a financial exit ramp. Then in May 2018, Donald Trump withdrew the United States from the JCPOA. He called it the worst deal ever negotiated. He reimposed the full sanctions regime and added new ones under what his administration called the maximum pressure campaign. The European companies that had just signed oil deals with Iran fled. No international bank would touch Iranian financial transactions. Oil exports collapsed again. The rial, which had partially recovered, went into freefall. This is where the consequences of the 70-year pattern become impossible to ignore. Every European company that had re-entered Iran after the JCPOA was forced to exit or face secondary sanctions from the United States. Volkswagen, Renault, Total, Siemens, Airbus, all of them wound down their Iranian operations within months. The financial isolation was total and almost instantaneous, and Iran, with no alternative market at scale beyond China, became increasingly dependent on selling its oil at steep discounts to Chinese refineries. By 2024 and into 2025, China was absorbing roughly 90% of all Iranian oil exports, mostly through a shadow fleet of tankers operating under flags of convenience, specifically to evade detection and sanctions. Iran was selling its oil at discounts of between $12 and $18 per barrel below benchmark prices, just to keep the barrels moving. Analysts estimated that in 2024 alone, Iran was losing over $16 billion per year in potential revenue, simply because of the discounts and transaction costs required to operate clandestinely. And still, of the total oil revenue Iran was earning, Iranian parliamentary budget investigators found that of $21 billion in reported oil sales over an 8-month period, only $13 billion reached public accounts. $8 billion was unaccounted for, sitting in opaque trust accounts siphoned off by intermediaries, or simply missing. Meanwhile, the United States was spending billions of dollars every year simply maintaining the military infrastructure required to enforce its regional position in the Gulf. The Fifth Fleet headquarters in Bahrain, bases in Qatar at Al Udeid, in Kuwait at Camp Arifjan, in Jordan, the UAE, and Saudi Arabia represent a regional military footprint maintained continuously for decades, with the Iranian threat as its central organizing logic. That peacetime maintenance cost across all the sites runs to tens of billions of dollars annually, all of it attached to the same 70-year conflict. By late 2025, Iran was facing economic protests on a scale that the government had not seen since 2019. The rials had lost staggering value. Inflation was running above 40% annually. The December 2025 protests were the most intense in years. And in that environment, in late January 2026, President Trump began publicly describing a massive fleet heading to the Persian Gulf. The USS Abraham Lincoln Carrier strike group was redeployed from the South China Sea. F-15E Strike Eagles deployed to Jordan. Tanker aircraft surged into Qatar. Missile defense batteries moved into position across the Gulf. On February 28, 2026, the United States and Israel launched joint military strikes against Iran. The operation was called Epic Fury. In the first 24 hours alone, estimates put U.S. military spending at $779 million. In the first 100 hours, the Center for Strategic and International Studies calculated the cost at $3.3 billion. The Anadolu Agency, compiling data from Pentagon budget submissions and Department of Defense cost tables, estimated that within 10 days, the total U.S. expenditure had reached $10.35 billion, an average of over $1 billion per day when combining operational spending with equipment losses. In those same 10 days, Iran struck back. Iranian missiles hit the Fifth Fleet headquarters in Bahrain, destroying communications terminals. At Camp Arifjan in Kuwait, satellite imagery confirmed destroyed radomes. A $1.1 billion early warning radar system at Al Udeid Air Base in Qatar was struck and damaged. 3 F-15E fighter jets worth $282 million were destroyed in a friendly fire incident with Kuwaiti air defenses. 3 U.S. Reaper surveillance drones were downed at roughly $30 million each. The financial cost of the opening days of direct military conflict was accumulating faster than almost any modern conflict in memory, and none of it was budgeted. Congress had not passed a war authorization. The Pentagon would need to go back to Capitol Hill for supplemental funding. The unplanned cost of an unplanned war was going on the national credit card, in the exact same tradition as every American conflict since Korea. And here's the second twist that ties this entire story together. The $10 billion spent in the first 10 days of direct military conflict against Iran is actually a small fraction of what this relationship has cost. Add up the $175 billion in lost American export revenue from 1995 to 2012. Add the intelligence operations, covert programs, and regime destabilization efforts whose price tags remain classified. Add the annual cost of the Fifth Fleet and the Gulf military infrastructure maintained for decades with Iran as the primary threat. Add the cost to the global oil market every time Iranian tensions spike the price of crude, costing oil importing economies billions. Add the diplomatic costs of the nuclear negotiations, the billions spent on enrichment monitoring infrastructure, the IAEA verification programs. Add the economic drag on every country that had to restructure trade and financial relationships around a set of Iran sanctions that changed repeatedly over 5 decades. The total of the U.S.-Iran conflict, properly accounted for, is a number that rivals the post-9/11 wars. Some researchers believe it exceeds them when you count the full indirect costs on both sides. Iran has lost somewhere between $300 and $450 billion in oil revenue to sanctions. The United States has sacrificed $135 to $175 billion in export revenue just from 1995 to 2012. The first week of direct military operations has already cost over $6 billion in munitions alone, according to Pentagon testimony to Congress. And the replenishment cost for those munitions, calculated by CSIS at $758 million per additional day at the tempo of the opening strikes, means the bill keeps climbing. And remember the Eisenhower principle. Every dollar spent on a conflict is a dollar that does not go somewhere else. CSIS calculates that $3.1 billion was needed to replenish munitions fired in the first 100 hours. That is enough money to build roughly 30 fully equipped public hospitals, or to fund free community college tuition for every student in the United States for nearly a year, or to repair a significant portion of the American infrastructure that the American Society of Civil Engineers currently rates as a C-. The opportunity cost is real. It just never appears in the same news cycle as the strike video. This was never just a conflict about nuclear enrichment or regional influence. At its core, the U.S.-Iran story is a financial story. It starts with an oil company that paid Iran 16 cents on every dollar earned from Iranian oil and refused to let anyone check the books. It moves through a CIA-backed coup designed to protect that arrangement. It accelerates through a revolution that was, in part, a response to that coup. It plays out across decades of sanctions, frozen assets, and economic warfare whose costs fell on ordinary people in Tehran and on ordinary exporters in Ohio and Pennsylvania with near equal measure. And it arrives here in 2026 with bombs falling and the meter running at $1 billion a day on a conflict that Congress did not authorize and for which no supplemental budget has been passed. History keeps its ledger. Every operation, every sanction, every frozen account, every barrel sold at a discount into a shadow fleet. The numbers get added up eventually, and somewhere in all of it, buried under decades of geopolitical framing and security briefings and press conferences, is the simplest truth in all of economics. War is the most expensive thing a government does, not because of the weapons or the fuel, because of the time, because the 70 years that have been spent building, maintaining, deploying, and now firing the machinery of this conflict were 70 years that could have been spent on something that lasted. If you want to understand how the economics of this conflict connect to oil markets, dollar dominance, and the financial architecture that governs every barrel of crude sold on Earth today, that story is coming next. Subscribe if you want to be there when it drops. And if this kind of financial deep dive into the real cost of conflict added something to how you see the world, the like button genuinely helps more people find this channel. See you in the next one. Thanks for watching.